Another question. I have a lot of families that make over 100,000 a year, and many of them think they don't have to fill out the FAFSA. What is the advice that you give to those income type families?
Yeah, the biggest thing that I would always say is that you want to fill out the FAFSA. It's called the Free Application for Federal Student Aid, right? The key word here is free. So what you want to be looking at is you might hear that a lot, and I hear the same thing. Like I don't qualify for anything. But what they're not talking about is some of the things that they do qualify. So they might not be qualifying for these need-based aids. So Pell grants, SEOG grants, MAP grants, things that you don't have to pay back. So the family that's making that 100,000, they're not going to be eligible for those things. But what they can be eligible for are going to be work study, federal direct Stafford loans for their student, and then also the Parent Plus loan. So these are, again, just additional tools that if you don't fill out the FAFSA, you're not going to be eligible for them. So taking student loans, for example, every student is going to be eligible for some student loans regardless of what their EFC is or regardless what their FAFSA says. So they do have those options to take those student loans out. And student loans are one of those things that we actually do recommend because it gives students a little skin in the game, gives them a little bit more of a realistic feel of, okay, I'm on the hook for this too. I'm not just out here on, mom and dad's dime and making the best of it. This gives them more of an opportunity to feel as though they're part of the process. So again, it's free. So we always recommend filling out that FAFSA.
Matt, while we're on the topic of need-based aid, Shane already kind of covered some information about merit-based aid. Let's dive deeper into need-based aid. Can you explain how colleges determine how much need-based aid students qualify for?
Yep, and so it's a really simple formula with a lot of moving pieces. So they're looking at your COA or cost of attendance, and I kind of want to pause on that because this is one of those things, and I'm trying to take you a little bit behind the scenes here, so giving you some tips on things to look out for when you get to this number. Cost of attendance is actually a legal definition. So when they list down cost of attendance, they're legally required to not only include tuition, room, and board, but also books, mandatory fees, transportation cost estimates, and as well as an estimate of student personal expenses. So the one thing I always say with this is you got to watch out. So your award letters will sometimes say COA on there, but sometimes they won't. Sometimes they're going to use terms like direct expenses. So these award letters aren't really telling you the whole story. So you're not going to know what the actual out the door cost might be. So really look for that cost of attendance or COA. So now that we got that kind of out of the way, you take your COA, cost of attendance, minus your EFC, which is when you fill out your FAFSA, it takes in your income, your assets, all of those things, and then it kicks out an expected family contribution. So if you take your cost of attendance minus your EFC, that is going to make your financial need. So quick example of that is if you have a college that's cost of attendance that's $50,000 and your EFC is $30,000, you now have $20,000 of demonstrated financial need. So basically, the EFC, that's what you're already on the hook for. No matter what, that's what you're responsible for. But after that, you do have a little bit of additional things. So that $20,000 of demonstrated financial need, that's what we're looking to have the college cover a little bit.
Okay, great. But isn't some of this done behind the scenes? In other words, aren't there other factors that play into it?
Yeah, and that's where we can take a look at the role of how they're filling those things. So we don't want to pay full boat, right? We don't want to pay the EFC as well as that demonstrated financial need. We want to see how the college can help us in filling that demonstrated financial need. So a couple of different ways that they can fill it out is with these items here. So gift aid in terms of grants, tuition discounts, and scholarships, those are the things that you're looking for, right? Those are gift aids. Those are things you don't have to pay back. So you're going to see a lot of schools will kind of promote this, right? They'll fill 70% of your need. Other one will be 40% of your demonstrated financial need. But it's really a matter of how they fill it, right? Gift aid is one way. The other way that they can fill that is with self-help aid. And self-help aid is basically taking out loans to cover those costs. So that's really not helping you a whole lot when it comes down to it. But to kind of show you an example of how this works, I'm going to show you 3 college reports that we had put together here. So we have this this family that we made here just kind of as an example for these pieces. But what we're looking at here is a family that's got a household income of $100,000, so I should say adjusted gross income. They also have $200,000 in investment real estate, and then they have $30,000 in a student savings account. So what I'm trying to show you here is, how can we reduce those EFCs? What are some strategies? And then also, it's not just as simple as reducing that EFC. It's trying to figure out how some of these gift aids go with it. So this is just a sample family. So if we take all the information that we have as is and put it into the FAFSA, you're going to get the before. So underneath estimated EFC, it says 29,885. So with all that information put in, that's what they're saying you are expecting to pay for college. Now, if we take a couple of changes and do just a few things using these strategies to help us, we can help reduce that EFC. So if we take this same $200,000 investment real estate, so they've got $200,000 of equity built up in this investment real estate. If we do what's legally required to have that formally recognized as a business, then that will no longer be part of your FAFSA calculations because your FAFSA does not ask you about small business values. So if we're able to do what's legally required, we can remove that from the equation. The other thing is if we take that $30,000 in a student savings account and we move that into the parent savings account, we're going to save ourselves a lot of money. The reason for that is that student savings accounts and parent savings accounts are looked at differently. So a student savings account is going to be assessed at 20 to 25% versus a parent savings account, which is going to be assessed at 5.64%. So right off the top, by moving those funds from one account to the other, you've saved yourself almost 15%. So looking at this after column, if we see that we make those changes, you can see the EFC gets reduced to 21,232. So $8,000 in savings almost right off the bat, just for doing those 2 things that are, within your easy changes to make to kind of help reduce those EFCs. All right, but you're probably saying to yourself, great, Matt, awesome, we figured out, we got two strategies, that'll be great. But unfortunately, it's not that simple. So I wanted to use 3 schools as an example to show you cost isn't always what it's cracked up to be, right? You can look at that sticker price and get scared off. And you might look at some of them and say, hey, that's affordable. But you really kind of have to, peel up layers back to try and figure out some of this part. So I'm looking at Clarion University here from Pennsylvania, right? So we use this one. Why? Because a few years ago, they reduced their cost of attendance, and that was their big selling point, right? So they're the inexpensive option. And if you look at it, cost of attendance is $32,233. So not bad, seems pretty affordable. But Shane touched on it a little bit earlier. Look at this graduation rate. There's big red flags here. Their 4-year graduation rate is 26%. So they might be less expensive, but odds are you're not getting out in 4 years, and it's going to cost you more money in the long run. And then you look at that 6-year graduation rate is at 52%. So that's pretty rough. So those are 2 red flags there. If we move down here just a little bit to this chart, this is basically what of that demonstrated financial need that we talked about, what they're going to fill. So their average need that they're going to be meeting is about 51%. And of that 51%, only 37% of that is going to be gift aid. So again, gift aid meaning the things you don't have to pay back. So if we go over here to this total family contribution in the after column, 26,622. So you're looking at that and saying, okay, it's still not that bad. But let's compare that here. So I want to compare this one to Bradley University. This is the exact same family, the exact same situation, but you can look up here and see that the cost of attendance is quite a bit more, right? Almost $50,000 for that cost of attendance. However, look at that graduation rate. 54% are graduating in 4 years. So odds are you're going to be able to get out of there in 4 years, which is going to save you money in the long run. Also, they're very generous in terms of what they've got for gift aid, right? So they are going to fill 73% of the average demonstrated financial need. And of that 73% they fill, 71% is gift aid. Again, those are the things you don't have to pay back. So if we take a look at the after column for the total family contribution, 28,726. So you're thinking to yourself, Matt, you obviously don't know how to do math, but it's true. It's just a matter of the way they're applying these things. So Clarion University, which is almost $20,000 less expensive than Bradley University, it's only going to cost you $2,000 more to go to Bradley based off of the way they're giving out that gift aid and the way that they're distributing it. So I'm using that as an example to say, hey, don't just get scared off by the sticker price. Really take a look and know what those things mean. The last example I'm going to give you is Northwestern University. And you're looking at this cost of attendance and you're like, oh, Matt, you're out of your mind for even showing me this, right? $80,000, that's crazy. But you can see 86% are graduating within 4 years, right? Obviously, this is one of more of elite schools, right? They're having some of the best go there, so they're graduating on time. But I use this as an example because I want you to look at this. They're filling, on average, 90% or 100% of that need is being met. Of that, 90% of that is going to be gift aid, right? They're really wanting to get those students in the door. They're wanting to get the best of the best. And so if we actually go over here to total family contribution, it's actually $16,921. That's what you're responsible for paying. So I bring these up as examples because I don't want you to say, oh, we can't afford that school. Let's take that one off the table. Really dive in, finding out how you can determine whether or not you will be able to afford it based off of how are they giving out that gift aid, how is it being offered, what are some of those scenarios. So those are just a couple of examples that can kind of help you with that. And these are those things that during that 1 hour Q&A that you're available to, if you bring some of your personal information along with you, we can actually provide the 3 of these for you so you can break it down and see how this would be kind of tailored to your style as well.
Matt, that blew my mind when I saw these reports the first time. Like, I never knew any of this when I was going to college, and it's crazy to think that colleges vary so differently in how they handle all of this. I know it's a lot to wrap your head around. Like, you have to really study these numbers to kind of really understand what's going on here. So I'm going to send out PDFs of all 3 of these via email after this, so you can take a closer look and try to digest a little more. And if you have questions, sign up for the free Q&A phone session that we're offering, or as Matt mentioned, sign up for the 1 hour free conference with our founder where he'll actually walk you through one with your own colleges that you want and your own numbers. So I highly recommend that. But Matt, I know that unfortunately it gets even a little more complicated because there are 2 different methodologies that colleges use to calculate EFC. So tell us about that.
Yeah, so it's not even just as easy as, fill out your FAFSA and break down these numbers and know all of these other percentages and all of the other nonsense that I just went over, right? It gets a little bit more difficult than that. So there's 2 different methodologies that will be used by the schools. So first is the federal methodology, which is the most common. So this one's going to be used at the majority of schools. So in the examples I just showed, Bradley and Clarion, they use the federal methodology. The other one is going to be the institutional methodology. This one is used at more of your elite schools like Northwestern that I showed you. The reason that I bring it up and why is there a difference, right? It matters on what they're looking at, because if you're going to try to implement some strategies to help reduce that overall EFC, you have to know which methodology your students are going to be using. So one thing will help in one area, one will not. So for example, the federal methodology does not consider non-custodial parent assets. It does not assess small business value like we just talked about. So if you do what's legally required and make that part of your business, they're not going to include that on those questions. It also does not assess any home equity that you might have. And finally, it does not assess sibling assets, which you might say to yourself, Matt, are you insane? Why would anyone worry about sibling assets? Well, there's a reason for it, and it's coming up, and we'll talk about it in just a minute. And there also is some student income protection allowance. So your student is able to make up to $6,667 per year without it impacting the FAFSA and then going into negatively impact that EFC. Now, the institutional methodology, basically just throw everything out that I just said because it kind of does what it wants. So it may assess non-custodial parent assets. Home equity is often assessed. Sibling assets are assessed. Any business value that you'd have is also assessed, and there is no student income protection allowance. So every dollar that the student earns goes directly on that FAFSA. So I'm not trying to say one's better than the other. There's different, and unfortunately, you're looking at some of these terms that I'm using. You're like, is often, may. It's like, give me an answer, Matt. But I don't have one for you because all of the institutional methodologies can look and pick and choose what they want to look at. So you might have two institutional methodology schools that look at different things. So it's really up to the school. So it's really difficult. But once you know which one you're going for or which methodology the schools are using, you can kind of figure out which one of these strategies might help the most. So just a quick example, if you're using federal methodology, you might say, oh, I can pay down home equity. So any assets that I might have, we can put it into the home and then they won't necessarily be showing on the FAFSA. That will work for the federal methodology. However, on the institutional methodology, they will assess that home equity, or I should say, they may assess that home equity. So you may have just gone through things and moved funding around and paid things down. That isn't really going to be helping you in the long run. So you just really want to make sure you know which one you're looking at.